Hi James, hi Steve. Thank you for joining me for our April market update. Recent news has been dominated by events in the Middle East again, with war in Iran at the forefront of investors' minds. We've spoken in the past about these big geopolitical events and how they haven't really moved markets. Has that been the case this time?
Yes, that's very much the case. I mean, the war started end of February, and since then we have seen an increased level of volatility in asset prices. That's both across stock markets and bond markets. In terms of equity markets, though, where we have seen some downside, it's been fairly well contained. For example, the US market, at its worst point, was down just a nudge over 5%. The rationale behind that is, yes, there's a war going on. There's concerns over its impact on inflation through higher energy costs, the impact on the oil price, most notably, and then the potential knock-on effect onto interest rates. That said, though, markets fundamentals, economic fundamentals, remain in good shape. The labour market is in fairly good shape, and there's good expectations for corporate earnings going forward. So markets to date are looking past the geopolitical noise to continued strength in corporate earnings. So that has translated into fairly robust market conditions. We've seen quite a bit more volatility in bond markets, particularly government bonds. And like I mentioned, there's concerns over the impact on inflation and thus the secondary impact on interest rates. Those interest rate concerns have really fed through to government bond markets. So the risk of markets trying to price in higher interest rates, that's certainly pushed the yield, the level of income achieved on government bonds, that's pushed that higher, and that's suppressed the capital values there.
Right, thanks for that, James. So in general, markets are fairly calm, but there were some areas within that suffered a little bit worse than that initial drawdown, didn't they?
There were, yes. So think energy intensive economies, the likes of Japan, Germany, and certain parts of Asian emerging markets. But again, I think the main two are Japan and Germany. So at their worst, Japan was down a touch over 13%, Germany roughly 12%. That compares to the around about 6% down in the US equity market. Key reasons there, yes, they're energy intensive economies, but also the likes of Japan, they get a significant portion of their energy imports via the Strait of Hormuz, which is where the war in Iran is focused.
Thanks, James. Steve, some people might be wondering why central banks would rise interest rates in response to an oil price increase.
It's a good question, and I'll give you a slightly fuzzy answer because the answer is it depends. But classically, central banks would look through increases in energy prices, mostly because there's not a lot raising interest rates is going to do to the price of oil. So if the Bank of England takes interest rates 25 or 50 bips higher, it's not really going to have a major impact on the price of oil. And also, there's this notion of sort of transitory effects. So because the Bank of England is focusing on inflation, which is a year-on-year comparison of costs, if you get an increase in oil prices, let's say you go from 60 to 120, that's a 100% increase in the oil price. But fast forward a year later, and if oil prices have stayed at the 100 mark or the 120 mark, your inflation is zero. And the central banks are actually targeting year-on-year increase in CPI. So this transitory notion is that it also relies on the fact that if the Bank of England raises interest rates, it takes a while for that interest rate rise to actually disseminate and have a full effect through the economy. And the sort of estimates for that is that it takes about a year or 18 months for an increase in interest rates. I mean, there's an immediate impact, but the full effect of that raise in interest rates takes about 18 months or so. And so if you're sort of targeting a sort of short-term increase in oil, you can see that by the time that the interest rate rises had a full effect, actually the impact from oil prices has disappeared from the mathematical calculation. So that's the sort of transitory effect. So classically, central banks would say, we're going to look through this rise and not really respond to it particularly. But that doesn't have a particularly good track record because the this is transitory argument was made in the after effects of the pandemic, and then you saw central banks saying we're going to look through these temporary factors, but then you had inflation which was lasting and more impactful. So the transitory argument is not one that if I was a governor of the Bank of England, it's not the argument I'd want to put at the forefront of why of what I was doing in terms of keeping interest rates on hold. So there's really a tendency, there's an expectation that if inflation maintains high levels, so let's say that the oil price stays high and that encourages inflation in the UK to be maybe above the 3.5% mark, certainly towards the 4% mark. I think there are members on the Bank of England's Monetary Policy Committee that would argue that, once you get to that sort of level of inflation, it's actually much more difficult to bring it down. So you need something extra on top of the wait for oil prices to come down hypothesis. You need something a bit more, and that's where the argument for interest rate rises will become, I think, a bit more convincing, and maybe more members of the MPC will be willing to vote for an increase in interest rates. But for the time being, the markets are sort of pricing in that prospect of interest rate increases. But for the time being, I think we're on. I think we're on hold for the foreseeable.
Thanks for that, Steve. That's a really good explanation. I know things are changing rapidly all the time, but what's the current sort of market prediction for the number of interest rate rises this year?
Yeah, they are moving pretty sharply. You can see the interest rate expectations basically are moving with oil prices. Oil prices are pretty volatile at this moment. So, but yeah, prior to the outbreak of hostilities, the market was pricing in 1, maybe 2 interest rate cuts, and we're now at the level where it's pricing in 2, maybe 3 interest rate increases. So you've got more than 100 basis points of interest rate expectations change there. So it's been quite substantial.
So peace talks are ongoing at the moment. If we did see a de-escalation and possibly a deal, how quickly might you see that energy price fall? And I suppose on the other side of that, if it does re-escalate again, how high could we see oil prices going?
Thank you for that question. I think let's put some reasonable expectations around this. Just a little bit of context. So if you look at oil prices over the last couple of decades, I think the peak point in my memory was back in 2008 when oil hit 144, something like that. And then during the Russian invasion, it reached about 122, something like that. At its highest point at this moment in time, depends which oil price you're looking at, but in terms of Brent crude, the highest point was about 112. So that I was slightly surprised that it didn't breach at least the 120 mark, but that's where we are. So let's call 144 our sort of high point, and then the lows of late, like as recently as last year, oil prices were just below 60. So call that 60 to 140, that kind of mark. Now, the reason I think the oil price is trading about 100, it's very volatile, but if you sort of look at it, if you squint and sort of try and average a price, it's around about the 100 mark over the last few weeks at least, with tilts towards the 140 when things look bad, and tilts towards back down to the 60 when things look good. So I think, the oil price is somewhere between those two levels. How quickly could it get down to the low level? Really quite quickly, I think. If there's a notion that some kind of deal is going to allow a vessel transit through the Strait of Hormuz to return to something like normal, I think what you're going to have there is an awful lot of pent-up supply reaching places, or at least setting off, at the same time that all kinds of governments have been taking various measures to try and insulate their citizens from these high oil prices, like there's the release of the strategic oil reserves and things like that. So you could have, in that set of circumstances, you could have a situation where global growth is slowed because of the high oil price, and now you've got this release of pent-up supply coinciding with a slowing in global demand for it. So you could get oil prices significantly, much lower than you'd imagine at this moment in time. So I'm not saying that that's the number one path that we expect. Equally, I don't really expect the 140 mark too. It's what we're doing is sort of trading in that range as the probabilities shift over time. But yeah, I think we could. I think oil prices could return to a much lower level than people anticipate at this moment if things go well. It's really about vessel transit through the Strait of Hormuz more than anything else. So if we get that returning to normal, I think the oil price calms down pretty quickly. But equally, if things escalate beyond here, I think there's some more upside on the oil price.
Okay. And if the oil prices do shoot up quite significantly, that results in recession, right?
There's a very good chance. Yeah. I mean, it depends. There's recessions and there's recessions. So historically, if you take the history of, say, the most important recession is going to be a US recession because it's a very dominant economy in the global economy. Its stock market is a very dominant stock market in the global stock market. So really, we're talking about a US recession rather than a British recession or a German recession, for example. It's a US recession that's likely to hit risky assets, equities, higher bonds, things like that. So it's a US recession that's going to hit the hardest. And historically, if you look at US recessions, they very often were preceded by a spike in energy prices. So there's that coincidence. So you want to be on alert for that kind of thing. But the US economy is quite different in terms of its makeup now and its sensitivity to energy prices than it once was. In the past, it imported most of its energy from overseas. So a spike in the price of oil meant that consumers were not just cutting their spending internally in the economy, they were also having to buy energy from outside. So in terms of GDP, lower consumer spending, but also an increase in imports. The difference between imports and exports that acts as a negative in that scenario. So there was money flowing out of the US economy. So it's quite easy to get it into recession in those circumstances. Now, of course, the US is one of the bigger producers of energy, imports far less, and it is on some measures a net exporter of energy too. So it's a slightly different matter now. So yeah, I mean, you have to be on alert for it, but whether or not a spike in oil prices is enough to get the US economy into recession imminently, there's not a lot of evidence to suggest that. Some of the economic data that we're seeing coming out of the US at this moment in time is not entirely not consistent at all with a recession. So we're not seeing it right now. But again, if oil prices do stay high or go much higher and stay high for a period of time, the damage will accumulate over a period of time. So we'll see where we get to. But at this moment in time, no real signs of a recession in the US.
So, James, we've covered how broad markets have got on in this period of volatility, but how have our portfolios performed?
Well, as we started this year, portfolios were well balanced and well diversified across the main asset classes, think bonds and equities. During this period, portfolios have held up very well. The areas that we were exposed to that we thought would hold up well have indeed done that. But in contrast, the areas that you may think would not hold up so well during this period have actually contributed to portfolio returns as well. In terms of the bond component, we are getting a good level of income there, which to a degree has offset some of the volatility that we've seen in that market. And across equities, yes, we do have exposure to some of the areas that have suffered from higher energy costs, like we mentioned earlier, Japan, Germany and the like. But we also have large exposures to the US, which has held up extremely well. And more sector-specific allocations, part of our defensive tilt, I think infrastructure through utilities exposure, they've made sizable contributions to the overall portfolio performance.
Okay, thank you, James. Thanks, Steve. That was really interesting.